Hello and welcome to today's RIMS webinar, sponsored by Hub International, ready for the unexpected strategies for property valuation, disaster recovery, and business continuity in 2025. I am Justin Smullison, Business Content Manager here at RIMS, the Risk and Insurance Management Society. Welcome. I have a few details for today's session that you need to know. If you have a question for the presenters during today's session, please submit them by writing in the question box. Feel free to ask at any point during the presentation. We will answer as many as we can. And for those we cannot address, the Hub team will reply to you directly. Following this session, the recording will be available through the on-demand events page of rims.org. And before we get started, RIMS is always proud of its strategic alliance with Hub International. They are the best. Our next webinar will be on Thursday, April 17th, and it will be the second in the Ready for Tomorrow series for 2025. We will post the webinar information again later, and you can register at rims.org/webinars. And Hub International will be at Risk World 2025 in Chicago, the Windy City, May 4th through May 7th. Visit them at booth number 471. And be sure to check out their speaking sessions. More info on those after the webinar. And all downloads and contact information will be accessible to the sponsor. And on with today's presentation. This is the kickoff of Hub's 2025 Ready for Tomorrow webinar series. Hub property experts are here to provide insights on valuation best practices, tips for building resilient recovery plans, methods on how to develop future focused business continuity plans, and discuss what successful organizations do to adapt to the evolving risk landscape. Now, RIMS is thrilled to welcome a large global audience. I would like to introduce our speakers. Now, first, we have our moderator, Executive Vice President and North American Property Practice Leader for Hub International, Blake Gjoshe. Next, we have our panelists bringing insights from a client perspective. We have Christopher McGill. He is the Chief Financial Officer at Creative Solutions in Healthcare. And also risk services expert Scott Fouts is here. He is the Senior Vice President and Risk Services Leader at Hub International. And finally, Jason Trahan. He is the Commercial Insurance Claims Practice Leader for Disaster Recovery Services. And now I will hand it off to our moderator, Blake, to get the conversation started.
Okay, thank you, Justin, and thank you, RIMS, for having us today. We've got some great things to discuss, and I'm fortunate to have some very talented individuals here with me to share some very important insights with all of you. While it is a presentation, we're going to try and keep it a bit more conversational for everyone out there watching. So let's jump into our discussion topics for today. We'll begin with a quick look at the current property market environment, including the critical component of valuation and the trends we are seeing in valuation. After that, we'll get into the topic of disaster recovery programs. From there, we'll discuss the ever-increasing importance of business continuity and the proactive planning that goes along with it. And finally, we'll open things up for some Q&A. So let's jump into our first portion of today's presentation. First, I want to address the property market on a high level, as it sets much of the stage for why we are discussing all of this today. Looking at the direct retail and wholesale market space, rate increases had been moderating and finally ended after 27 consecutive quarters of average rate increases. So certainly a prolonged hard market, as many of you have all seen and experienced, I'm sure. Insurance companies finally returned to profitability, and they got those combined ratios below 100. Just a quick point of explanation there. When an insured's combined ratio is above 100, it means they're paying out more in claims and expenses than they are receiving in premiums, indicating an underwriting loss and signifying that the company is not profitable from its core insurance operations. Now, that could be propped up with favorable investment income and some other factors, but essentially, they're losing money on their insurance business. And that was generally the case for most property insurers during this prolonged hard market. The laws of supply and demand, they're playing their part. Increased capacity means increased competition, and that includes single carrier programs as well as on shared and layered programs, which are once again seeing cases of overlining and oversubscription, thus pushing rates downward. The reinsurance segment, a major leading indicator for the retail insurance space, it's shown its own signs of recovery and return to stability, particularly when you talk about pricing. That said, there's been little softening on terms, especially when it comes to retentions in the working layers. Keep in mind these are generalities, and exceptions and outliers, exist, and they will continue to exist. Okay, we can move to the next slide. Despite the return to profitability of many of the insurance companies, the marketplace remains very guarded and underwriters still have their concerns. I always like to share statistics in discussions like this. I think they really resonate and provide some context. So I have a bunch here for you. The industry saw over $154 billion in global nat cat losses last year, 117 billion of which was in the US. If you look 5 years prior to that, the annual average was 101 billion. If you look 5 years further back from that, the average was 70 billion. So you can see the troubling trend that these numbers are taking. And with these larger numbers, it's becoming more of the new bar that underwriters must contemplate in their capacity commitments and their price setting. Some further stats, there were 27 weather and climate related events last year that each resulted in $1 billion or more in insured losses. The record is 28 events, and that was just back in 2023. So 27 events, as I just mentioned, for 2024. But the average, when you look at the period from 1980 to 2023 on an inflation adjusted basis, is only 8.5 events per year. So another troubling upward trend in unfavorable loss activity. A quick note about Canada. Canada was unfortunately no exception to these unfavorable trends. It was the costliest year on record as respects severe weather events there. 2024's total is nearly triple the total insured losses recorded in Canada for 2023. And that's 12 times the annual average in the decade between 2001 and 2010. So much of this has been marked by the emergence of the concept of secondary perils and events that were previously unmodeled and unrated for. Several years ago, and for the many years leading up to the last few, when underwriters talked about cat exposure, it was wind, it was earthquake, it was flood. Now it still includes those, but probably ahead of those for many underwriters is severe convective storm, wildfire, and just severe weather in general. All that's been traditionally classified as secondary perils. Now we could devote an entire webinar and then some to specific events that we've seen, even just looking back to the devastating wildfires in California last month. Then on top of that, you have the catastrophic hurricanes and floods we saw at the end of the summer, and just the continued severe weather activity that is plaguing so many areas. The main point is that we're all seeing and experiencing more intense and more powerful events, coupled with increased exposures, thus creating more larger, more significant losses. So even as the market potentially eases on rates, underwriting discipline is expected to remain. With that in mind, differentiation from other accounts will continue to be a factor. Underwriters want to know that exposures are being accurately represented. Equally important, they want to see that if and when something does go wrong, that clients have adequate business continuity plans and disaster recovery plans in place. So next slide, please. So a big part of that underwriting discipline that I mentioned centers on the topic of values and accurate valuation. As we all know, this is the first link in the chain of data as it makes its way through modeling, limit setting, analysis, and underwriting. Bad valuation means bad data, and it impacts everything that follows in the process after it. We have a very telling statistic here, which is that property replacement costs are up on average 30 to 40% over the past 5 to 6 years. Now, that's the average based on inflation and trend factors, buildings being on the higher end, equipment on the lower end. That's not contemplating some clients needing to increase by more than that to fall in line with current values adequacy. This is from the combined effects of record inflation and in some cases underreporting of values. When I say underreporting, it wasn't something that necessarily happened in 1 year. Rather, in many cases, it was unintentionally falling off of the accurate values trajectory over the course of several renewal cycles. Unfortunately, a lot of this shortfall in valuation came to light on a post-loss basis, which yielded unpleasant surprises for both clients and underwriters. For clients, it may have been in the form of limit inadequacy or underinsurance. For underwriters, it came in the form of more severe losses than what they modeled for the premiums they charged, and even the capacity they deployed or the attachment points they took on a program. Even now, many insurers, they're still running their own valuations and rating off of what they feel the values should be. So one trend that's emerged was the increased frequency of restrictive policy language. What I mean by that is coinsurance, margin clauses, occurrence limit of liability wording, and just other forms of scheduling policies based on reported values. While these have historically served as kind of a safety net of sorts for insurers, the addition of them became more frequent of a response to a disconnect between what the insurers feel a reported value should be and what was actually being reported. Also, and on a related note, if a company is in a high growth mode or very decentralized, they may not even know about certain locations that they may have. So it's even more important in that case to stay on top of scheduling provisions that may exist in the policies, as well as newly acquired and miscellaneous unnamed location coverage. So after several years of corrections to values and an easing of inflation rates, we're seeing more stability with year-over-year values reporting expectations, particularly as respects to physical damage values. Machinery and equipment could still be more difficult to value due to uniqueness or age of a particular item, but there's been an evolution of improved valuation tools, and hopefully that's going to continue to make the process better and more efficient. That said, business interruption and contingent time element, those both remain a concern as they're inherently more difficult to derive. In the case of business interruption, BI worksheets have become more of a focus and a requirement from underwriters as opposed to just being a nice to have. Interdependency is something that clients are also examining more closely. Do they have key locations that, if impacted, would cause downtime at other company sites? Contingent time element brings its own set of challenges as there's just more unknowns, particularly as you get out beyond your first tier direct suppliers and customers. Supply chain makeups, they've gotten much more complex. Many underwriters are pushing for greater visibility into the process flows of the products. They're viewing and they're treating third-party locations essentially as if they were first-party locations. They want to know if the location attributes, they want to know the COPE, they want to know CAT exposure, and especially they want to know the loss control efforts that are being made at these third-party sites. You also have the issue of compounded exposures and accumulations in certain fields. Think manufacturing, so semiconductors being an example in the tech space. You have many companies going to the same limited number of critical suppliers for a key input. So going forward, one thing that's being emphasized is the importance of value trending on a go-forward basis. Those trend factors, they've thankfully come down significantly from the high points that we've seen over the past several years. We're now seeing an average of 1.5% to 3% as compared to over 10% and well into the teens a couple of years ago. You see the collective fatigue of having gone through these valuation resets, most of which were overlaid with repeated rate increases. So now that continued valuation discipline is top of mind for underwriters and lenders. Both want to make sure that the values don't fall out of range again. Labor costs, that's a continued focal point. Something else to be watched is the notion of potential tariffs. I saw a recent statistic, 35 to 40% of building materials are imported. So there is consideration that needs to be given on what the impact of tariffs, if imposed, could be on valuation. Now, there are other key items that underwriters are looking for. We're going to get into those next. Before we turn it over to Jason to take us through building a disaster recovery plan, I have a question for you, Chris. Can you give some commentary for our viewers on what you have seen and experienced as respects your values and valuation, whether it be your approach to it, how you've dealt with the record inflation, and anything else you see as relevant and worth sharing?
Yeah, absolutely. Thank you for the question, Blake. More importantly, thank you for the opportunity to give a unique client perspective on all this. So, as it relates to the valuations, unfortunately, I've experienced several issues when working with statement of values. As you had mentioned, we have had several nursing homes that have been left off the SOV completely. This is a result of an organization my size growing about 20 locations a year, which is why we've learned from our mistakes, and we emphasize during the due diligence period of curating as much information from the prior operator as possible. This would include, getting their previous statement of values that they've submitted for their previous renewal, as well as their loss history. Another big issue that we were running into was the business interruption. The BI worksheets are very important. It's very important for your brokers to intimately understand your business. What you end up doing if they're not intimately aware of how your business operates is you run the risk of either being underinsured, if you have an operation that shuts down, which will obviously impact your P&L and cash flow, but you also run the risk of being overinsured. I'll give you an example. In our organization, when we have a loss, the majority of our employees are hourly. And what we can do to try to salvage as many of those hourly employees as possible is to, move them to a nearby sister location. Previously we had been insuring the entire wages of all the employees, but whenever we separated out those hourly employees from the BI value, it was a tremendous savings on cost. To improve accuracy on our total SOVs, we really subscribe to implementing secondary modifiers. For instance, giving the carriers a better depiction of the roof types, the roof ages, sprinkler systems, the inspection reports, and the maintenance protocols, things like that, that really give the carriers a more accurate representation of the SOV. I think you kind of hit the nail on the head when you said that data is key. And the more accurate data that you have, the better solution that you'll have when dealing with the carriers, because the lack of good data, they're always going to assume the worst.
Excellent. All valid points and great examples. I'm sure sounds pretty familiar to everybody that's tuning in. So thank you, Chris. All right, Jason, let's get into the topic of disaster recovery plans.
Yeah, thanks, Blake. So because we assist clients with losses, we often get asked the question, what could we do better? How could we set up a plan to better prepare for this? And a lot of times people see it as pretty daunting. So our goal is to try to simplify things. What we want to do is roll a process in here that you're already doing every year through your property renewal. But let's do a few additional steps on here that can make all the difference whenever you do incur a loss. So some of the things I'm going to talk about may sound a bit like Captain Obvious comments, but time and time again, we deal with clients who are surprised by some of these items because they didn't look into it proactively and know the landscape of their coverage and how they would recover after a loss event. And that starts with reviewing your policy for the key items that you're going to need after a loss. That starts with limits. So as Blake just said, markets have been hard for a long time. So maybe back in the old days when people had blanket limits for everything and it kind of covered up a lot of the misvaluation or improper valuation of items. Now things are very strict, typically according to the SOBs. So making sure you know what your limits are for your individual assets, for the building, business personal property, as well as the business interruption that you've got on there. Understanding your limits of extra expense, and then understanding how those limits bridge over to the different endorsements. So if you've got, as Blake mentioned on the contingent time element, if that's a big exposure for you, what are your endorsement limits for that? What are your endorsement limits for dependent time element, dependent locations? And also, too, for other time element extensions like civil authority, ingress, egress, service interruption. If those are things that as you look through your loss history or things that you've encountered, make sure you understand what those endorsements say and what their limitations are. Is it ingress, egress within 1 mile of the location or 5 miles of the location? Is the wording prevent or impair? All these things are understanding more of the specific wording in your policy, because this is how you're going to access these different endorsements, that are going to apply these limits. And then also valuation provisions, understanding, do you have finished goods at selling price? Or do you have them at just replacement cost? Those could be some impacts. Those could also impact what you're reporting in your values for your BI. Because if you've got, say, a stock throughput agreement at selling price, well, you need to credit those BI values for the BI value of that stock throughput at selling price to make sure you're not purchasing too much coverage, to Chris's point. We want to make sure you're accurately insured, but in today's hard market and rates, want to make sure you're not purchasing more than you need. But then those valuation provisions also carry over into property. Chris mentioned roofs and roof conditions. There's a lot of provisions now because hail and convective storm have really impacted the markets, that they're saying, hey, any roof that's older than, say, 10 years old, 12 years old is only actual cash value. Understand that, because once you get into the percentage deductibles that may apply to that peril, the valuation provision on the roof, you may not be collecting as much when you have a loss like that than you think you are. And you need to be able to plan for that and understand that. Also, then going into exclusions, what is the property policy actually kicking out and saying you don't have coverage for? This was most apparent a few years ago, like when COVID hit everybody. You heard a lot of people, especially like restaurant chains that we dealt with, say, well, I've got civil authority coverage, so the government shut us down, so I've got coverage. And yes, they did. They had that coverage endorsement. However, it was an excluded peril because they had no coverage for infectious disease or virus. So the actual thing that was causing the civil authority was excluded. So understanding that, so you know what your exposures are. It's not always, oh, I don't have earthquake coverage, or my flood coverage is limited. There's a lot of other exclusions that could apply in there that impact your operations. So you really need to review your policy and review it in the context of your business operations, your historic losses, to understand and make sure that your policy is going to respond to you. And then read and understand your deductibles and how they apply. And I cannot enforce this enough, because your deductibles are how you access your policy. So a lot of times I'll work with manufacturing losses, and they'll have a 10-day average daily value deductible for a location, which is common for manufacturers. But if you are a labor-intensive business, most don't understand that the definition of arriving at that average daily value doesn't allow you to deduct labor. It's just revenue less cost of goods sold. And so you could wind up with a 10-day ADV that to you as a manufacturer actually means more like 15 days, maybe even 20 days of loss before you're sort of in the money and into your policy. And a lot of people don't understand that. Or you get into flood deductibles, windstorm deductibles, even convective storm now with hail and wind that carry percentage deductibles. Okay, what does that percentage apply to? Is it to per unit of insurance, meaning building, meaning business personal property, meaning business interruption? Or is it a percentage of your total insured values? Think through that. So if you just have physical damage to your building, why do I have to suck up, say, a 5% deductible to business personal property in my business interruption just to access being able to repair my building? So having those deductibles by per unit of insurance is key. And then what is the percentage applied to? Is it the value on the statement of values? Or is it, as some forms say, the value of the asset on the date of loss? I've worked some horror stories with clients where the reported value on the SOV, before a hurricane was half to 1/3 of the assessed value of the building after the hurricane damaged it. So what they thought was going to be a $300,000 deductible wound up being a $900,000 deductible whenever the building was reassessed, on the date of loss. So understanding those deductibles and how they apply is really key, because as a risk manager or insurance professional, when those losses happen, your C-suite and your CFO is going to be calling you wanting to know what's the deductible and what is our coverage. And you want to be able to tell them. So know those deductibles. Also, verifying the statement of values. We've touched on this a little bit, making sure that you're including all your locations. That's the worst conversation to have with a client, is they have a loss. You're looking through the SOV, it's not even listed. And then all of a sudden you're relegated to what could be a small undisclosed location sublimit of maybe 500,000 or $1 million. And then we've been harping on this, so I won't say too much, but reflect the values that are current and accurate. This is key here because, as Chris said, you don't want to be underinsured or overinsured. And when you're looking at specific values on the SOV, I see a lot of clients are like, oh, the overall SOV is within 5% of where it needs to be. Well, that's great until the fire happens at the one location that happens to be 20% underreported. And then you've got issues because you could be restricted by coinsurance in these days, or even margin clauses that might kick in where you're only allowed to claim 10% above that reported value. Or you may have an 80% coinsurance provision where you're going to share in that loss on a pro rata basis if your values are not 80% of what they should have been at the date of loss. So those are all things to be thinking about. So Chris, this kind of goes to a question of most of the people and most of our viewers probably not coverage experts. So as a client, what are some questions and meetings that you could have with your broker to make sure you understand some of the stuff we just talked about?
Yeah. Thank you, Jason. Well, since most people are not coverage experts, I just want to start off by saying there are no dumb questions. Ask any and all questions you have until you have a thorough understanding of your program, your pricing, and your service. When it comes to your program, make sure that you understand which each line of coverage is covering, to your point that you had made before, Jason. And like you had said about deductibles, make sure that you understand how they're being calculated. Is it a flat rate? Is it a percent of total replacement cost? What exactly is the deductible? When it comes to pricing, make sure that you're asking questions about rates. Are all of your businesses covered under the same blanket policy? When we transitioned brokers this most recent renewal, we had several dozen locations that were under a separate policy, which had a significant price delta that was not favorable. It was important for our new brokers to understand why the businesses were bifurcated into two separate policies so that they could work on trying to tie those outliers into the main blanket coverage. When it comes to service, this is one of the ones that gets overlooked by most clients, I'd say, in the renewal discussions. Servicing questions are important to understand what to expect when you have a loss. One thing that I think is a good habit, especially when transitioning to a new broker, is to go through your loss history. Have discussions with them saying, if we had this loss today, what would be the steps to filing the claim? Once the claim is filed, then what is the next steps from there? And then what do I do if I'm dealing with an adjuster who is giving me heartburn and not really aligned with the way that we want them to be aligned?
No, that's great, Chris. And that's actually a good segue into the second half of this slide, because now as part of the recovery plan, oh no, please go back. There we go. So now that we've read through the coverages and we kind of understand how the policy is going to apply, whenever we do have a loss, now we need to set up that plan for how we're going to respond when a loss does occur. And that starts with establishing relationships with those vendors that are going to help you through it. And there's a lot of maybe specific vendors to consider depending on your business type. You could be, if you're a manufacturer that's got a very specialized line of equipment that help you do things, those might be some vendors you want to make sure you got on standby, whether they're OEMs or whether they are separate third-party guys that can help you repair and scope those damages whenever a loss does occur. But the one that everybody needs, that's kind of the common denominator, is going to be restoration and repairs after a loss. So we highly advise having a standby contract with a best-in-class national restoration and repair vendor to help you in the event of anything, whether that's water damage, whether that's fire damage, whether it's a flood event, a hurricane, anything that might damage you, making sure that you've got a vendor that knows you, you know them, they're familiar with your locations. Ideally, they're tracking your locations. And when a loss does occur, they're going to respond immediately to you and be able to help you recover. Because the goal is to try to reinstate that asset as quickly as possible to minimize the time element impact for you. Benefits you because you'd rather sell goods and services to your customers than to the insurance carrier. And then it's obviously going to help as you go through renewals if you can keep that loss ratio down, as Blake discussed earlier. So consider those standby contracts. They typically don't cost you anything. So please just, reach out to your broker for recommendations or other colleagues that you have in your industry to get those recommendations. Also, take some of the uncertainty out of it. Consider designating certain folks in your policy so that you don't have the issue that Chris said of maybe an adjuster that's a little disagreeable. Find an adjuster that knows your business, someone maybe that you've worked with on past losses or were recommended by a colleague or a peer, and get them named into your policy. Not just the adjustment firm, the specific adjuster. Try to get a good senior EGA or regional leader. There may be individual field adjusters that show up to your loss after an event, but make sure that you've got someone kind of higher up in the organization that you can go to if there are any gray areas in your loss and your recovery. And also consider getting a standby for claim preparation assistance, someone to quarterback that claim preparation so that you present a well-documented loss to the insurance carrier. That is the fastest way for you to get recovered and paid. And for those public entities that are our viewers here today, also consider having a standby with a FEMA specialist. If you are a qualifying public entity, a city, municipality, higher ed, K-12, nonprofit hospital, when you have a loss, you could also have FEMA available to you depending the type of disaster that occurs. And so make sure you have that FEMA consultant on standby as well too. Again, this takes out a lot of the uncertainty and puts things back in your court as to knowing who's going to help you after a loss. So Chris, maybe to ask you a second question here, as someone that has encountered losses before you had a plan and then after you had a plan, maybe give some examples to our viewers of how things went better afterwards.
Absolutely. Well, I'll give you an example. In March of 22, about 1 month into my CFO-ship, we experienced a tornado that caused significant structural damage that required us to evacuate all of our patients. Candidly, we were not primed with the resources that we have today. We found ourselves scrambling to not only understand our coverage, but more importantly, scrambling to find a contractor to help with the disaster recovery. We made a mistake that I think several businesses do. We initially went to utilizing our day-to-day vendors rather than search the market for a reputable firm that specializes in disaster restoration. Our day-to-day vendors, they really didn't have a good understanding for the claim process or the documentation requirement to reach alignment with the insurance carriers. And it was a disaster all in itself. This proved to be problematic to the recovery because, as you guys know, if things aren't kosher with the insurance, then the construction, gets held up. We learned that to fix the problem, we had to, develop a process which we engage proactively with a vendor that specializes in restoration, a vendor that understands the insurance process through and through, and could continuously provide documentation not only to us as the client, but as well as the carriers. So until we had that alignment, it really made life difficult. Once we subscribed to this, master service agreement with a reputable firm, it has really made it a lot easier to where we can focus on, the business and know that we have the restoration piece figured out.
Excellent. Thank you, Jason, and Chris. Thanks again for the added commentary.
Yep.
Scott, you've been patiently waiting. Jason walked us through all the key elements and aspects of disaster recovery. Let's spend some time now on the ever critical subject of business continuity.
Yeah, absolutely. So I know our first slide kind of talks about our left of loss, and this was actually created by our OR team at Hub And as Blake and Jason and Chris provided, like, it's really great insight for valuation, disaster recovery. All the areas are left of loss. But when you really talk about all the foundational pieces that go into it, it's really the business continuity program that kind of builds that out and provides the foundation, not only for the disaster recovery, but, you know, setting up the conversation on Flipboard to make sure you have those remediation contractors, having those vendor partnerships and all those items in place so that you can get back to operational support faster and quicker and get back to operational status. So I think it's probably key to, you know, kind of differentiate the two. So when you think about business continuity, it's really just a strategic playbook to help an organization maintain or at least get back to business, where disaster recovery really looks at the business plan, looks no matter what the responding catastrophic event gets you back to business, look at those contractors, but make sure that you have the right contractors, whether it's with like an MVP, like a DRS program has, or making sure that you have a reputable contractor to get back in place. But generally speaking, that left of loss, all the things that we're talking about today is that event. So that QR code that you see there, if you scan it, it'll actually take you to a lot of Hub International resources that our crisis management team, our OR team, and everyone is put together. And it doesn't matter whether it's hurricanes, earthquakes, we have all of our resources right there. They're free on their external website for Hub International. Now, once that event happens, from a business continuity standpoint, it flipboards into that response. Whether you have somebody like a DRS team, like a Jason and Corey and the DRS kind of group, or you have a national claims team like our Dave Schmill, or our property team to help kind of respond after an event. Those are all things kind of cradle to grave when you think about a business continuity plan. So I'll bring Chris kind of back into to the conversation here. Chris, you talked about some of the challenges you all faced not having one and having one now. What are some of the common challenges that you think that you all have, or maybe organizations have, when trying to create an initial business continuity plan? Because I know it can be overwhelming because there's so many parts. But what were some of the challenges that you all were able to overcome as you built out your plan?
Yeah, I mean, for us, the number one priority in business continuity is obviously the patient security and the employee safety, right? You know, we accomplish this by evacuating our residents and staff as soon as possible, and, you know, execute shelter in place provisions if needed, if we're not able to get them out as soon as possible. So for us, whenever we have a big loss and we're contemplating business continuity, oftentimes what we're doing is we're kind of shifting the entire organization to focus on those primary concerns that we have. Well, now that we've kind of subscribed to a disaster recovery coalition with firms like Jason's firm and our master service agreement contractor, Cotton Global, we can really lean on them to be able to contemplate all of these other things while we are focused on the business, right? So I often refer to Jason's team as the easy button. I think that anyone that's contemplating, you know, subscribing to a similar program, you're going to come to the same insight that we have, because, you know, there's just so many things that are happening in the business, even from a CFO perspective, whenever there is a loss, to be able to lean on someone that's outside of the organization to be able to handle the things like claim preparation, to be able to mobilize the troops from the contractor. Those are all important things that I think are important. One specific thing that we've done to kind of help is we've really focused on amping up our communication. So if there is a potential disaster in one of the regions that you know, we operate in, you know, we're providing front end communication to prepare each of the locations. But even from like the technical aspect of communication, we're in the process of outfitting our facilities with satellite communication, satellite internet. We have a lot of locations that are rural as well as urban. And we know how important communication is at the facility front level. And we don't want to be stuck where we're not able to communicate directly if there's a power outage or a cell phone tower that gets taken out by a hurricane or a tornado. And so that's something that we've contemplated, that we're in the process of outfitting all of our facilities, because communication is key.
No, that's all great to hear. It actually takes us right into our next slide. So I appreciate that nice tee up.
Okay.
When you think about developing those written business continuity plans, obviously communication being part of that, that starts with the team members. To me, knowing you have the right team members, the right communication, whether it's Slack or some other platform, those are really the flipboard that starts kind of the foundation of that business continuity plan. I'll create a little bit of a circle of life here, but as you taught, it reminded me that it all comes down to operations, personnel, and administration. And that personnel is the key component, like making sure everybody's safe, making sure everybody can either get back to work safely or back to operational status. But there are some key stakeholders, whether it's knowledge experts or people that know how to run equipment or know how the operation should go. That personnel is usually typically the first thing that we want to make sure we get in place. And then those other buckets being operations and administrations. I think both you and Jason and even Blake had talked earlier about making sure that we have the right vendors, the right suppliers, making sure everything is kind of neatly kind of compartmentalized with each department to make sure that you have the right suppliers. And everybody worries about kind of the downfield stream when an event happens, making sure that you still get out your product. But what happens, if you're in the same town, say it's Charlotte, North Carolina, where I'm at, and a storm hits, but one of my biggest suppliers or one of my biggest vendor partnerships are in Charlotte and they go down too. Like that becomes a little bit of the flipboard to me of the conversation of like, what is the moderate to high probability of something happen from a geographical location to moderate to high impact? And I know we kind of talked through this as we were preparing for the presentation, but as you were thinking about your approach from an organizational standpoint, not just from a business continuity and your relationship with DRS, but how often maybe you're looking at reviewing your operational exposures, but how often are you looking at your vendors, your suppliers, and people that are departments or even vendor partnerships that are critical for you all getting back to operation?
Sure. I would say, definitely at each renewal, we're evaluating what went right, what went wrong, where was our biggest exposure. Even if we didn't have a loss, sometimes, we squeak by, and it could have been just, 1 mile up the road. And so we kind of discuss, okay, well, in that event, what would we have done to prepare? So definitely at each renewal, we tend to bring all of our partners in at some point in the renewal process where we're all under the same roof. That would include, brokers, contractors, suppliers, Jason and his team, and we discuss, specific losses and what, like I had mentioned before, what we learned from them. Oftentimes, we're also discussing trends that we are seeing in the market and how we would respond to those. Whether they're trends that are happening over the state, over the country, or even the globe. And we make sure that, like you had mentioned, our suppliers are, well supplied from a logistics perspective. And then, contingent suppliers that we would lean on to if for whatever reason we can't, get a generator or what have you. And if we feel like we have exposure during the renewal process, which for us is about a 3-month runway, then we address it right then and there, and we come up with a plan with specific timelines on what to do.
Yeah, and again, it kind of bolting on to what you were just talking about. Like to me, those contingencies, those backups, the whether it's assets, alternate work location, physical locations, equipment. I talk to clients all the time where they have one piece of equipment that drives 80% of their revenue, and it's going to take them 6 months to get it in the door to get back up operational. That all becomes part of that conversation of like having real tough, difficult conversations, but you need real answers. Like, single points of failures exist in every organization. Where would that be?
Yeah, I'll give you a kind of an extreme example as well. So when Hurricane Harvey hit, we had several locations in the Vidor and the Beaumont location that we were not able to get supplies in. So all of our distributors, weren't able to get their trucks in to provide, life-saving pharmaceutical drugs or what have you. And so we had a contingency plan that we had to go through the filing cabinet and dust off. But essentially, we rented a bunch of different U-Haul vans, went straight to the distributor, and we said, we'll find a way. You know, it was key to getting that life-saving care that we needed in the business continuity. And there was a lot of operators in our space that didn't have those plans. And unfortunate for the business and for the, you know, the residents and what have you. But it is extremely important to have those contingency plans, even if they seem, you know, crazy, like getting your accounting and finance staff to drive U-Hauls to go deliver pharmaceuticals. Well, you know, Hurricane Harvey obviously was something that no one really contemplated. So just as crazy as a disaster could be, your contingency plan needs to be as equally creative from that standpoint.
Okay. So as we transition to the last slide here, and then we'll turn it back over to Blake, I'd love to bring Jason in. Jason, I know you and I work with clients all the time together, where we're kind of teeing up the conversation of preparing the crisis management team, doing a business impact analysis, and we're even seeing carriers now tell us, like like Blake said, that business impact analysis, business continuity, they used to be good to have, now they're table stakes. When you're planning those objectives, when you're talking to clients, like, how does that conversation come to you all, not just from a DRS standpoint, but how are you seeing that market change a little bit when you're talking to them, knowing that operational exposures change, you're doing this business impact analysis, and what are those key components that you're speaking about?
Yeah, no, thanks, Scott. I had to use my own little business continuity plan for my own service interruption loss here of logging in separately, but it's got to always have a backup. But no, I mean, I think that the comments that you're talking about is maybe clarifying for our viewers too, that the business continuity plan is the plan that you have to try to maintain those operations in the event of a loss event, where your disaster recovery plan is, what are the steps I'm going to take to get me back to that condition that existed at the state of at the date of loss? Mm-hmm. And those, I mean, those are just critical now, because insurance has become very tight, limits have become very restrictive, and it really puts a lot of that back onto the policyholder to make sure that you can recover and minimize loss as much as possible, because you may be subjected to limits in those areas that hit. And so it's become much more of a conversation, I think, with our clients, especially on a proactive basis, but they're still overwhelmed by the task. And that's why our goal has always been to try to simplify it, to make sure that they talk with folks like you, Scott, for the business continuity planning that can kind of help walk them through that and keep that thing current, so that you don't encounter what Chris said, where you're dusting off the old binder out of the drawer when a loss event happens, trying to figure out, how you're going to respond there. So, but on the disaster recovery side, you're refreshing those vendors each and every year, and you should be. And testing those things out. And I've had some clients that are very good on the business continuity planning side by taking those vendors that they're going to rely on for plan B, if you will, and testing them each quarter. I've got, one client, he's bottling and beverage manufacturer, and they test out, their backup plan, whether it's the packaging, whether it's the bottling, whether it's the concentrate, once a quarter. They run something with those vendors to have them prove that they can perform each and every quarter, so if they do have a big loss event, they can respond. Those types of things are definitely best practices on the business continuity plan, and then keeping those vendors fresh on the disaster recovery. So with that, I'm going to turn it back over to Blake.
Okay. Well, thank you all for the input and commentary. Super insightful. As I mentioned earlier, much of what we've talked about today, it's no longer nice to have. It's really a necessity if you want to differentiate, if you want to set yourself apart from others in the property insurance submission pile. Even putting the insurance component aside, though, these items are key to the viability and even survival of a company in the wake of a loss. Chris, you were talking about the Harvey loss, and you mentioned a phrase that I found very remarkable: a loss we've never contemplated. Sadly, I think there's been a lot of those types of losses in the industry over the last couple of years, especially as we see some of these more extreme weather events. It's losses that people never contemplated. So you have to be ready to respond one way or the other to these types of losses. I've got to think a lot of what was said today is very relatable to our viewers and what they've personally seen and experienced over the past several years and what continue to experience in the current efforts and your daily activities. This wraps up the various items of discussion. So now we're gonna move to our Q&A, and we do have some questions in the queue because I've been watching. So first one is, how often should we review and revise our business continuity and disaster recovery plans? So I'll start off, Scott. I'm gonna have you take us through this one.
Sure. I would say at minimum annually, but as vendor partnerships change, as team members change, people, leave companies or come to companies. The idea is as operational things change within the organization, you acquire facilities, all of those operational changes should be attached to the business continuity plan, and also updated with your broker and your carrier to make sure that you have the right coverage in place. So I think it's ongoing. It's an evolving document, live document, but I would say at least minimum annually. But as you make operational changes and personnel changes, I think those revisions need to be updated and make sure that a copy and testing is provided to the program.
Okay, excellent. Here's another one. Let's see. Based on current insurance models, what incentive do property and building owners have to absorb risk? I'll start a response, but panelists feel free to chime in as well. I'd say retention has definitely been a subject that's come up a lot over the last couple of years, especially as the costs and rates got out of range of we'll call it the pain thresholds for a lot of clients. The clients that didn't have losses in particular started to say, you know what, we're better off retaining some of this risk ourselves. The models will continue to be there. The models will continue to say what the probabilities are of losses and what was, what's the probability of loss and what should I do in the way of retaining it. The one thing I say to clients that haven't experienced losses is you may want to consider retaining risk within the program rather than bringing up your deductibles. It just gives you a little additional flexibility the following year or in subsequent years if you want to dial back the amount of retention you have. I think there's kind of the unspoken rule that we all know is that when you take a higher retention, the credit you get, you're going to spend a lot more to bring that retention back down in the form of a deductible if you decide to reduce it in future years. So that's my 2 cents. I'll open it up to the panelists for any additional comments there.
No, I think one thing that's important there is even as you're increasing those retentions, it still doesn't lessen the importance of having these plans. In fact, it increases it, especially on the disaster recovery side, because now you're just absorbing, more of that loss on the front end. So getting back into operation as quickly as possible is even more critical. So making sure you've got those vendors on tap to help you as soon as that loss event occurs, so that you can get what I always say, get the bricks and sticks fixed as quickly as possible to get you back in operation.
Thanks, Jason. Question, let's see. Okay, so Jason, here's one for you, actually. You had mentioned margin clauses earlier. In the context of margin clauses, when is valuation considered off to the point where it needs to be investigated further?
That really depends on your coverages. I mean, so you need to look at it and see, if you're looking at your overall SOV and you're 5 percentage points off, 8 percentage points off, okay, you need to start looking, well, what's my margin clause? Do I only have 5% wiggle room or 10% wiggle room? Probably need to tighten things down on the valuation, maybe do some appraisals on my largest buildings, to hone in what that risk is. And then making sure the BI values are accurate. There's really kind of no excuse for that. No one knows your P&L like you do. So go through that and figure out what your operational BI, business interruption, would be in the event of a loss, and making sure that BI value worksheet reflects that. There's a lot of errors in translation. So we always recommend start with your P&L. You know what your BI should be. Make sure that BI value worksheet reflects it.
Like I was going to add another thing,
Please
thinking
do.
about
Yeah.
percentages being off. You have a large portfolio in a lot of locations. Those percentages add up. So whenever you start doing cap modeling for different perils, whether it's quake, fire, flood, that number can be skewed if you don't have the right, values in the overall, especially when it comes to business interruption, as Jason was talking about.
Thanks, Scott. Okay, a question around BI worksheets. BI worksheets we have seen from carriers often do not seem applicable to services-only organizations. Are you aware of worksheets or resources more on point for service industries?
This one is kind of hard because BI worksheets are different for everybody. So what I always recommend is sitting down with your own profit and loss statement and kind of almost reiterating what I just said in the last question. Go through your own P&L and figure out what your BI value should be. Okay, so then you know where you should wind up. What's the bottom right-hand number that I should end up with at the time? And then kind of forcing that into the BI value worksheet, whether you're using a carrier one or your broker's giving you one. There are some kind of more industry specific, I'd say manufacturing versus non-manufacturing. But you get into a lot of niche businesses and there's just not that many BI value worksheets out there. So start with your own P&L, make sure you know what the number is that you should be insuring and reflect that in whatever BI value worksheets put in front of you.
Yeah. And Jason, I'd like to add to that. So if you were like me and presented with this BI worksheet, that, we understand our P&Ls very well, but it's a different scope whenever you first take a look at the BI worksheet. I would encourage having conversations with your broker or even the carrier to understand exactly what the end goal is. That way that you can kind of, guide how you're imputing the values on that BI worksheet. Talk to someone that truly understands, what the end goal is for the coverage. That way you can focus in on how does that translate to my business. I think that's very important. And they'll all be motivated to, doing a step-by-step review with you on that piece.
Excellent. I'm watching the clock, so we're just about out of time. But as Justin mentioned, if we didn't get to your question, we will respond to you directly afterwards. I know there were a few that we did not get to. With all that said, thank you, Chris, Jason, and Scott, for your input today. Thank you, everyone, for tuning in. I'm going to turn it back over to you, Justin, to make a few important announcements and close us out.
All right, that was great. You did. You covered a lot of questions. You're going to address more afterward. I'd like to thank Christopher McGill, Jason Trahan, Scott Fouts, and Blake Giannis for their time and expertise. The Hub International team has your questions, as we said, and will reply directly to you if we didn't address them today. A copy of this webinar will be archived on rims.org within a few business days. And folks, mark down April 17th on your calendar, your digital calendar or your print calendar. Hub International's next Ready for Tomorrow series webinar will be on April 17th. It is called From Defense to Prevention, Strengthening Your Liability Risk Management Approach. The registration link will be live soon. Be sure to check rims.org/webinars for more information. And for more about Hub, you can visit hubinternational.com and follow them on LinkedIn. As I said at the top, RIMS is so thrilled to continue our partnership with Hub International in person at Risk World 2025, which will be held in Chicago May 4th through May 7th. Be sure to stop by Hub International's booth, which is number 471. They will host speaking sessions as well, including the ABCs of ESG, how institutions get schooled on responsibility and transparency. Protect and Swerve, I like that. How to fluidly manage global risk programs in an ever-changing world, and driving DEIA strategies for building inclusive international organizations. Public registration is now open for Risk World, and if you register by Friday, you get the super savings rate. Continue to broaden your risk knowledge with Hub International and RIMS at Risk World. Register at rims.org/riskworld. Finally, RIMS is global. We'd love for you to build your network with us. Visit rims.org/membership to apply for a RIMS membership. This was a great session. We covered a lot. Hope you all learned a lot and enjoyed. Thank you all and stay safe.